everybody, and today we'll talk about crude oil and how to trade it. Crude oil trading offers excellent opportunities to profit in nearly all market conditions due to its unique standing with the world's economic and political system. Also, energy sector volatility has risen sharply in recent years, ensuring strong trends that can produce consistent returns for short-term win traders and long-term timing strategies. Market participants often fail to take full advantage of crude oil fluctuations either because they haven't learned the unique characteristic of this market or because they're unaware of the hidden pitfalls that can eat into earnings. In addition, not all energy-focused financial instruments are created equally, with a subset of these securities more likely to produce positive results. Learn what moves crude oil. Crude oil moves throughout the perception of supply and demand, affected by worldwide output as well as global economic prosperity. Oversupply and shrinking demand encourage traders to sell crude oil markets to lower ground, while rising demand and decline of flat production encourage traders to bid crude oil to higher ground. Tight convergence between positive elements can produce powerful uptrends, like the surge of crude oil to $145.81 per barrel in July 2008, while tight convergence between negative elements can create equally powerful downtrends, like the August 2015 collapse to $37.75 per barrel. Price action trends to build narrow trading ranges when crude oil reacts to mixed conditions, with the sideways action often persisting for years at a time. Understand the crowd. Professional traders and hedgers dominate the energy future markets, with industry players taking a position to offset physical exposure while hedge funds speculate on long and short-term direction. Retail traders and investors expert less influence here than is in more emotional markets like precious metals or high beta growth stocks. Retail's influence rises then crude oil trends sharply, attracting capital from small players who are drawn into these markets by front-page headlines and table-pounding talking heads. These absent waves of greed and fear can intensify underlying trend momentum. Choose between Brent and WTI crude oil. Crude oil trades throughout two primary markets, West Texas Intermediate crude and Brent crude. WTI originates the U.S. Permian Basin and offers local sources, while Brent comes from more than a dozen fields in the North Atlantic. These varieties contain different sulfur content and API gravity, with the lower levels commonly called light sweet crude oil. Brent has become a better indicator of worldwide pricing in recent years, although WTI in 2017 was more heavily traded in the world futures market. Pricing between these grades stayed within a narrow band for years. But they came to an end in 2010 when the two markets diverged sharply due to a rapidly changing supply versus demand environment. The rise of USA oil production, driven by shale and fracking technology, increased WTI output. At the same time, Brent drilling underwent a rapid decrease. U.S. law dating back to the Arab oil embargo in 1970s aggravated this division, prohibiting local oil companies from selling their inventory in overseas market. This ban was removed in 2015. Many of CME Group New York Merchant Exchange futures contract track the VTI benchmark with the CL ticker, attracting significant daily volume. The majority of future traders can focus exclusively on this contract and its many derivatives. Exchange-traded funds and exchange-traded notes offer equity access to crude oil, but their mathematical condition generates significant limitation due to contango and backwardation. Read the long-term chart. VTI crude oil rose after World War II, peaking in the upper $2 and entering a narrow band until the embargo in 1970s triggered a parabolic rally to $120. It peaked late in the decade and began a tortoise decline, dropping into the teens ahead of the new millennium. Crude oil entered a new and powerful uptrend in 1999, rising to an all-time high at $157.73 in June 2008. It then dropped into a massive trading range between that level and the upper 20s, sitting around $55 at the end of 2017. As of February 13, 2020, it closed at $51.52. Pick up your venue. The NYMEX VTI Light Sweet Crude Oil futures contract sale traders in excess of 10 million contracts per month, offering superb liquidity. However, it has a relatively high risk due to the 1,000 barrel contract unit as a 0.01 per barrel minimum price fluctuation. There are dozens of other energy-based products offering throughout NYMEX, with the vast majority attracting professional speculators but few private traders or investors. The U.S. Oil Fund offers the most popular way to play crude oil throughout equity, posting average daily volume in excess of 20 million shares. This security tracks VTI futures, but it's vulnerable to contango due to discrepancies between front-month and longer-dated contracts that reduce the size of the price extensions. Oil companies and sector funds offer diverse industry exposure with the production, exploration, and oil service operation presenting different trends and opportunities. While the majority of companies track general crude oil trends, they can diverge sharply for long periods. These counter swings occur then equity markets are trading sharply, with the rallies or sell-offs triggering cross-market correlation that promotes lockstep behavior between their sectors. Reverse currencies offer an excellent way to take long-term crude oil exposure with the economies of many nations leverage closely to their energy resources. US dollar crosses with the Colombian and Mexican peso under tickets USD COP and USD MXN have been tracking crude oil for years, offering speculators highly liquid and easily scaled access to uptrends and downtrends. Bearish crude oil positions require buying these crosses, while bullish positions require selling them short. Investors have many options for gaining exposure to oil as an investment. These methods come from varying degrees of risk and range from direct investment in oil as a commodity to indirect exposure in oil through the ownership of energy-related equities, ETFs, or option contracts. Each of these um, investment types can be acquired throughout an online brokerage account or directly throughout the broker. For today, that is all. Thank you so much for your attention. Wish you great trades. Stay safe. See you soon.